Hello, and welcome to Corporate Finance. I am Dr. Moultrie. In this video, we will discuss Chapter 1 of Corporate Finance. And Chapter 1 deals with the corporate finance and the financial manager. Corporate finance and the financial manager. So what we'll discuss in Chapter 1 are, why should we study finance? We'll discuss the 4 types of firms, the financial manager, the financial manager's place in the corporation, the stock market, and financial institutions. The objectives for Chapter 1 are: grasp the importance of financial information in both your personal and business lives, understand the important features of the 4 main types of firms, and see why the advantages of the corporate form have led to dominate economic activity. Explain the goal of the financial manager and the reasoning behind that goal, as well as understand the 3 main types of decisions a financial manager makes. The other objectives are: know how a corporation is managed and controlled, the financial manager's place in it, and some of the ethical issues financial managers face. Understand the importance of financial markets, such as stock markets, to a corporation and the financial manager's role as liaison to those markets. And last but not least, recognize the role that financial institutions play in the financial cycle of the economy. So why should we study finance? Why study finance? Well, studying finance empowers individuals to navigate crucial decisions regarding their personal finances. It equips them with the skills needed to make informed choices, such as determining the optimal timing and amount for retirement savings. Additionally, a grasp of finance enables individuals to discern between the advantages of a car loan versus a lease, and also evaluate whether a specific stock aligns with their investment goals and risk tolerance. So understanding finance also allows for a careful assessment of the terms and implications of a home mortgage, ensuring individuals make sound financial commitments. So in essence, studying finance provides the knowledge and the tools necessary to confidently manage financial matters, making informed choices that align with long-term financial goals and stability. Studying finance also becomes a pivotal asset in a business career, addressing critical questions that often arise in decision-making. Professionals equipped with finance knowledge can effectively assess whether their firm should venture into launching a new product, evaluating the potential risk and returns. They possess the analytical skills to evaluate and select the most viable supplier for their firm, considering factors like cost, quality, and reliability. Understanding finance aids in determining whether in-house production or outsourcing is more advantageous. factoring costs, efficiency, and expertise. Finance expertise enables decision makers to deliberate or on whether to issue new stocks or opt for borrowing, understanding the implications on the firm's capital structure and financial health. Additionally, for startup ventures, knowledge and finance provides insights into various fundraising avenues, offering strategies and methods to secure capital for the fledgling business. Ultimately, studying finance in a business context empowers professionals to navigate complex decisions, optimizing outcomes, and fostering financial success within their organization. There are 4 types of firms. The book lists sole proprietorships, partnerships, limited liability companies, and corporations. We'll discuss first sole proprietorship. A sole proprietorship is a straightforward and common form of business organization, particularly favored by many new ventures. It stands out for its simplicity, where the business and its owner are essentially one and the same. In this setup, the principal limitation lies in the absence of a legal separation between the firm and its owner. Now, this means that the owner assumes full responsibility for the business's debts and liabilities. Importantly, a sole proprietorship can only have a single owner who retains complete control over decision-making and operations. Now, while this structure offers autonomy and ease of establishment, it also carries the risk of personal liability for the owner, making it crucial for them to consider the potential risk and benefits before opting for this type of business form. Now, one of the defining characteristics of a sole proprietorship is that the owner assumes unlimited personal liability for the firm's debts and obligations. This means that the owner's personal assets are at risk to cover any business debts incurred. Additionally, the life of a sole proprietorship is intricately tied to the life of the owner. If the owner chooses to retire, or if the owner decides to sell or passes away, the business typically ceases to exist, making it somewhat reliant on the owner's presence. Furthermore, due to the direct association between the owner and the business, transferring ownership of a sole proprietorship can be challenging. The intricacies of personal involvement and liability often make it difficult to transfer the business to another individual, thereby limiting the options for passing the business on to others. The other type of firm is partnership. Well, with a partnership, you have more than one owner. All partners are liable for the firm's debt. A lender can require any partner to repay all the firm's outstanding debts. The partnership ends on the death or the withdrawal of any single partner, and partners can avoid liquidation if the partnership agreement provides for alternatives such as buyout of a deceased or withdrawn partner. A limited partnership is a partnership with two kinds of owners: the general partners and unlimited partners. The general partners have the same rights and privileges as partners in a general partnership, are personally liable for the firm's debt obligations. With the limited partners, they have limited liability and their ownership interest is transferable, and they have no management authority. The other type of firm is the limited liability companies, or LLC. Now, the LLC is a flexible and popular business structure that combines elements of a corporation and a partnership or a sole proprietorship. Now, one of its key features is the limitation it offers on the personal liability of its owners, known as members. Now, this means that in most situations, members' personal assets are protected from the company's debts and liabilities. LLCs also provide flexibility in management, allowing members to choose between member managed or manager managed structures, giving them control over the company's operations. Another advantage is to pass through taxation, where the LLC itself is not taxed and profits and losses are passed through to the members who report them on their individual tax returns. The other type of firm is corporations. Now, a corporation is a distinct legal entity that is created by law. It's separate from its owners, known as shareholders, of course. Now, this separation grants the corporation its own identity and legal standing. Much like an individual, a corporation possesses numerous legal powers. It can engage in contracts, it can acquire assets, and also take on obligations in its own name, independent of its shareholders. Now, corporations benefit from constitutional protections against property seizure, safeguarding their assets from undue confiscation. Now, this unique legal status provides corporations with the ability to function as independent entities, conduct business affairs, and be held accountable under the law, separate from the individuals who own or manage it. Now, a corporation bears sole responsibility for its obligation, thereby shielding its owners from any liabilities arising from the corporation's commitments. The owners or the shareholders, they enjoy limited liability, and they are not personally accountable for the corporation's obligations. So the corporation remains uninvolved and is not liable for the personal obligations of its owners, ensuring a clear separation between the entity's responsibilities and those of its individual stakeholders. The formation of a corporation, it involves several legal steps to establish its existence. First, it must be legally formed, usually requiring a formal process and documentation. Now, this includes obtaining a charter in the state where the corporation is incorporated, outlining the foundational rules and guidelines governing its operations, which is known as the corporate charter. Now, this charter sets the initial framework for how the corporation is structured and also how it is managed. However, this process tends to be more expensive compared to setting up a sole proprietorship due to the legal complexities and formalities involved in establishing the corporate entity. Now, corporations have no setup cap on the number of owners they can have. The ownership of a corporation is delineated into shares, termed as stock. It represents a fractional ownership in the company. So in other words, you as a stockholder, you have ownership in the company. The collection of all the outstanding shares of the corporation is known as the equity of the corporation. The ownership structure of a corporation revolves around shares of stock held by individuals known as shareholders, stockholders, or equity holder. Now, these shareholders have entitlements to dividend payments, typically receiving a portion of dividends corresponding to the quantity of stock they possess within the company, right? So this arrangement allows for a proportional distribution of dividends among the shareholders based on their respective shareholdings. There are no restrictions on who can own stock in a corporation, which allows for a broad spectrum of ownership possibilities without any specific limitations. Here in this figure 1.1, it shows you the 4 types of firms, the major types here in the US. According to this figure here, as A and B shows, although the majority of US firms are sole proprietorships, they generate only a small fraction of total revenue, in contrast to corporations. Corporate entities face distinct tax implications where the profits generated are subject to taxation, independent of the owner's tax responsibilities. Now, this results in a scenario where shareholders may encounter double taxation. Initially, the corporation itself is taxed on its profits. Subsequently, when the remaining profits are disbursed to the shareholders, now these individuals are liable to pay personal income taxes on the dividends that they receive, making a second taxation phase for the same earnings. Here in this example 1.1, taxation of corporate earnings, here's a problem. You are a shareholder in a corporation. The corporation earns $8 per share before taxes. After it has paid taxes, it will distribute the rest of its earnings to you as a dividend. We make this simplifying assumption, but should note that most corporations retain some of their earnings for reinvestment. The dividend is income to you, so you will then pay taxes on these earnings. The corporate tax rate is 25%, and your tax rate on dividend income is 20%. How much of the earnings remains after all taxes are paid? All right, here's the plan. Earnings before taxes, it's the $8. There's 25% corporate tax rate, and then there's the 20% personal dividend tax rate. So to calculate the corporation's earnings after taxes, first we subtract the taxes paid at the corporate level from the pre-tax earnings of the $8. The taxes paid will be 25%, which is the corporate tax rate of the $8. Since all of the after corporate tax earnings will be paid to you as dividend, you will pay taxes of 20% on that amount. The amount left over is what remains after all taxes are paid. And here is where we execute it. You have the $8 per share times the 25%, which is $2 in taxes at the corporate level, leaving $8 minus $2, $6 in after corporate tax earnings per share to distribute. So you will pay the $6 times the 20%. The 20% of the $6 you will pay, which is $1.20 in taxes on that dividend, leaving you with $4.80 from the original $8 after all taxes. So as a shareholder, you keep $4.80 of the original $8 in earnings. The remaining $2 plus $1.20 is equal to $3.20 is paid as taxes. So the total effective rate is $3.20 divided by 8 equal 40%. And we will pause here. Okay, so this is the end of part 1. Please look out for part 2 of corporate finance. of chapter 1. We will continue chapter 1 in the next video, so please watch out for the next video. Thank you for watching, and feel free to reach out to me if you have any questions. My phone number, email address, and my website is listed below. Also, you can reach out to me via these social media platforms. Again, thank you. And if you have any questions or comments, please put them in the section below. Until next time, this is Dr. Moultrie. Thank you for watching, and please do not forget to click the like and subscribe button. And if you have any questions or comments, please leave them below.